Manish bhai, good morning.
Good morning, Nikon. Came show.
I can reply back in Gujarati. I've learned over in the last 10 years. Okay. Uh, world moves in a pattern, which is that if there is problem in terms of growth, then, or if there's problem of growth, then gold goes up. If there's problem of inflation, gold goes up. If there is a fear of recession, then equities go down. Last night, everything went down. Gold, silver, Bitcoin. Why have we seen such a massive synchronized sell-off last night, at least in US markets?
So if uncertainty goes up, in general, sort of that the typical reflex that you talked about does happen, but we are in uncharted territory, Nikunj, right? It's never happened that a country like US actually is behaving the way it's acting like the way it is, and so therefore the whole purpose of sort of creating this chaos is to actually weaken dollar. And that, of course, gold has been pricing all along, and of course, extremely super expensive. So don't read too much into gold's move yesterday. It could be a little bit of a sort of a sell-on news story. But for everything else, dollar didn't behave the way. If the U.S. recession were to be there, ideally, dollar should have strengthened, but didn't happen because U.S. wants dollar to weaken. Doge and tariffs actually will certainly dampen U.S. growth expectation, and therefore it should mean bonds actually rally. And I've made this argument many times that tariffs are actually good for bonds. Equity, of course, because uncertainty is going up, so of course it's sort of falling off quite substantially. So outside of gold, it's sort of a thing that I can reason. Gold's behavior looks like a little bit of a valuation concern and sell on news story instead of how the macro reflexes play out.
What could be the playbook at play now? Uncertainty, recession, bond yields going here or there. So, for example, there was a playbook which was at play at COVID. There was a playbook at play in 2008. There was a playbook at play when 9/11 happened. This time it's different.
It's different.
So, how will asset synchronization or interplay moves now?
So underneath Nikunj is sort of this belief in US that, and I think that memo has not been served to Indians and most specifically Indian investors, that most likely China has won. So it's just a matter of time, 10, 15 years, that it would become a hegemon. And therefore try everything else to try everything to one, create chaos so that secure some victory of this a likely otherwise failure. And second, I think more importantly for US is to ensure that at least the supply chain, manufacturing, and tech sort of superiority is secured in some form or other by creating all of this that they're doing. I think the instrument to do, Nikunj, is to weaken the dollar, lower the interest rates, and of course cut the spending and cut the taxes so that you bring the lot of investment back in US. So in a sense, it's a typical MAGA that Trump has talked of, and that's the playbook. Impact of that is, of course, is that I think US rates are headed much lower than what markets are pricing. Fed will deliver significant rate cuts. I think equity won't like the fact that Doge and everything else would secure US recession, a significant slowdown in US for sure. Earnings are high, margins are high there, so I think that will give up. And dollar, I think what they're looking for. In 2 minutes, you really can't explain much, but it's in dollar. I think somewhat paradoxically, this time the dollar would actually continue to weaken. So in some sense, it's a different market setup. But that looks like a playbook. Its impact on various countries will be different. Small countries will be roasted. Yeah, larger country, India would be relatively better, not because our exports to US are small. It's just that we are a large country. I don't think it will impact China substantially. And US, it will impact, but the small countries like Bangladesh, Cambodia, and all will be totally roasted. So that's how I think the next 6-12 months, will play out.
भाई we've spoken about Bangladesh, Vietnam, China. अब इंडिया की बात करते हैं, right? Come back to India. Now, I'm going to put the playbook into play just for the benefit of our viewers, and you can fill in the blanks. They say a weak dollar is good for emerging market flows.
Yes.
They say a fall in yields, and if it goes below 4% to 3.5%, is great news for emerging market inflows. And they say a weak declining interest rate is good news for equities. Why? Because margins will come back, and then P re-rating happens. So what you're telling me as a playbook technically means that what has happened or what will happen in the next couple of days indirectly is advantage India.
Yeah, so you're right that the second order, if the rates are lower, dollar is weak. Ideally it should mean that any asset could be repriced higher. The long duration assets should reprice higher. But if you are telling me that US slowdown, significant slowdown, and its impact thereof on India is already priced in, then that should play out. So it's a little bit of 2022 like setup, not exactly, but 2022. You're seeing equity markets in US are selling off for the fear that there would be substantial slowdown. Its impact on India, because Indian growth also is somewhat proxy to global growth and specifically US growth. I think India too will not see the cyclical recovery that we were all hoping for. So in a sense, if it's more likely, Nikunj, again, very, very uncertain times, but more likely, Nikunj, that margins in India, which are still sort of very, very elevated, will roll over. And that is the part that, equity markets are sort of not liking for the last 6 months. I think that would continue to sort of trouble you. But again, if you were to be a pure equity investors between US equity and Indian equity actually look a better place, because the fear of, massive dollar, what do you call strengthening is gone now, or rupee weakening is gone. RBI can cut rates now. And India has seen a cyclical slowdown already for the last 6, 8, 10 months. So at some point in time, some cyclical recovery will begin to happen with policy assistance. So I think, purely from the point of view of US versus India trade, after very, very long, India looking a better place than US today.
Sure. So, Manish, what should an Indian investor do? Because limited as one's exposure would be, or even instruments to invest across the globe, you only have your own domestic market largely to play with, other than ETFs of some other countries and, of course, US exposure. What should be the construct of your portfolio in the next 3 months, in the next 6 months, and then beyond that?
So I think my favorite trade for a good 1.5 year has been that bonds will do better than equity. I think that stays even today. I think you would still see 10-year bond piercing 6% in 12-18 months time, and that essentially means that you would gain near double-digit return. Likely that you won't get that in equity. So purely at a macro level, you'll have a long bond underweight equity trade even today playing out. But at some point in time, almost certainly, when the capitulation is in, I think valuations are starting to look decent. You would have an opportunity to dial up equity. So maybe that's sort of Diwali, December. I don't know who when, but seems like after very long, there is an opportunity coming up for dialing up equity in India again. So, but that's still sort of far out. Until you see a little bit of a semblance of reasonability, across the world, and more specifically in India, if you have decent amount of rate cuts coming in, which sort of starting to sort of pull up the economic growth again, that is when you should sort of dial up. But valuations are sort of decent. It's just that the bond valuations are still better, and they still have sort of a momentum going on for them. So you would get sort of reasonable returns there.
You're saying that it's bonds over equity, at least in the near term. That's the sure call, right?
Yep.
Okay.
Okay. Well, let's wait for the improvement in economic indicators and then dial into equities. But can I argue back and say that haven't the indicators improved already? GST collection,
Yes.
the rupee, forex reserves. I mean, you know the data more than me.
Yes. No, they have. Which is why I think India has a cyclical rebound underway right now. That's the point I made. It's just that in absence of all that Trump has done, had Trump actually response underwhelmed, likely I would have actually make this argument on your show today that yes, it's a decent time to actually add risk in India. It's just that Trump tariffs actually bring a lot more uncertainty than what I had also imagined for. Almost certainly it's worse than what the worst case scenario that I had sort of penciled in. So to that extent, why jump into all of this risk, when there is so much uncertainty all around you. But I'm with you on this. It's very, very likely that Indian economic rebound is certainly underway. Is just that if US were to slow down at margin and exports to US actually going to slow, then it's very, very unlikely to pencil a significant rebound in India. It's possible if let's say rate cuts in India come in a significant manner, sort of currency sort of stays here for long, at margin, government does few things, though the space to do anything substantial with the government is very little. I think, India would rebound. So in 5-6 months time, I genuinely think that, India would begin to sort of have a decent rebound. And so for a guy who's not simply looking at catching the bottom, maybe it's a decent time to actually dial in risk, Nikunj. It's just that, my framework, and I kind of like to think capitulation is sort of an important precondition to dial up risk in equity markets, and that hasn't happened in India. At some point in time, VIX will shoot up. The fear gauges will start to go up, and that is when maybe it'll be a better time from a purely cyclical standpoint. But otherwise, at margin, if you're doing SIP, continue with that.
Yeah, absolutely. One doesn't stop their SIPs. But Maneesh, you've talked about the cyclical rebound. Tell me, at least, you think one thing is established for sure, that you can't be putting money into globally linked sectors, at least. That's something you need to avoid right now. And you have to look at domestic facing sectors and stocks.
Yes, that's true. That's true. Basically, because anything China proxy, which sort of we compete with China or we sort of export to US, these are two avoidable sectors. I think Mahesh was there on the show and I heard him. It's pretty much similar views. I think, BFSI, even though there are some cracks in the portfolios, are more local focused because liquidity is easing at margin. Thinks, they'll be the first market actually to recover, first sector to recover. Again, hyper local consumption, would actually do decently all right. So discretionary, I'm not so sure yet, but sort of staples actually would do better, especially in the context that they've underperformed quite substantially. So yes, the local consumption and BFSI are places where you can hide because the impact of sort of Trump tariff tantrums is actually much less there.
So where does gold fit in now? It has gone up when 2024 and early part of 2025, where world's not been that bad. It's only in last 2 or 3 weeks we are trying to understand what the shape of the world would be. Gold should be going up now, but gold has gone up before the trouble.
No, I mean, look, markets have this ears, right, to ground more than all of us. And which is why we must pay heed to what markets are doing. So gold has been doing what Trump did day for yesterday, right? So it's actually, in some sense, gold got this right all along for so long, right? All of us were speculating on lots of things, but then gold was getting it right. Dollar is getting it right again. So, and now bonds are getting it right, of course. Equity finally said that, oh God, kya ho gaya? So, it's getting it right. So, but, gold was the first instrument, all along has been getting it right that, look, US systems are going to get upended, that US will do something dramatic. And therefore, lots and lots of people, like, think of it, from a Chinese or Indian standpoint, what is the point of, especially in Chinese standpoint, what is the point of accumulating all the reserves in dollar terms? Because if you were to have an issue with US tomorrow, the reserves that you have in dollar actually will go to naught. Exactly what happened to Russia. So to that extent, you sort of have no global currency left, for a guy who's perhaps not in the camp of US for sure, as an ally or friend. So that is what perhaps has been driving gold all along for the last couple of years. So I wouldn't bother too much about what happened in last 2 days. That seems like a little bit of gold is extremely expensive, Nikunj, extremely expensive in any metric. Of course, you guys all putting out this charts that Nifty has of course underperformed gold for last couple of 2 decades at least. Very very expensive for a zero coupon infinite bond. It's very expensive. So what is playing out, of course, in gold in last 2 days could be simply a sell-on news, as I said. Also, from an allocation point of view, it's time to be sort of super concerned about gold valuations now. So I don't think it's a time to dial up gold in any meaningful fashion.
That's all about gold, where you firmly believe that it is a sell-on news story right now, and given the fact the valuation is actually concerning when you talk about the gold and the way it's rallied. Very good morning to you, Mr. Dangi. Cheryl also joining in the conversation. I just wanted to ask you about the fact that the way how this entire tariff or the MAGA playbook is at play right now. The problem has been that we've also not, as a nation, come to a decision when you talk about how we will react to the tariffs, what will we do next. And on back of that, you have a lot of corporates on tenterhooks as well. So how should one actually gauge this entire environment when you are betting on these sectors that are impacted actually on back of this tariff announcements?
Look, there are two bullies right now out there, between US and China until they sort of figure out what to do, for small nations. Of course, we're not so small, but, I think that Playbook and Delhi is, of course, to be a little bit status quo-ish, play along, do a little bit of tariff cuts and see what happens, we're not going to be sort of prime movers. And you're right, the corporates today, if let's say until about few weeks ago, someone was thinking of actually setting up large plants, new facilities, this uncertainty certainly means he'll be fearful that, okay, what if, these 50% tariffs on China means that China begins to dump in India steel or anything else, would sort of government continue to play ball in actually increasing tariffs in an environment where US is demanding lower tariffs. So all these essentially means that the sentiments in the corporate boardroom actually will be dampened today with respect to sort of investing. So if anyone was hoping that a corporate investment recovery would sort of will come now, I think at margin you should actually lower the bets further there. As such, that's been a disappointment for all along, and I made this point many times on your show. I think, at margin, that part of the business in India will continue to disappoint even more significantly given the uncertainty that we are in. It is true that, of course, there are certain sectors where there is a decent demand, local demand, if there could be some gains here and there. But a major corporate capex is very, very unlikely to sort of play out. And by the way, if you sort of understand the profit pool theory, if investments don't pick up in a meaningful fashions, eventually, the profits don't rise because, these two are sort of super correlated. And which is why I kind of think that the margins in India are still very, very elevated for anyone's comfort. They will likely go down instead of go up from here.
Where do you see that profit pool, though? Do you think banks is the obvious choice?
Yes.
Yeah.
So banks seem all right. They've been under tremendous duress, Aisha, over the last couple of years, and more so in last 1.5 years. Tight liquidity, hyper competition, margins are low. You've seen, some of the bankers, ex-bankers actually tweeting all around that, how on earth you actually lend for a 10-15 year mortgage at 8.5%, where blended cost is actually 9.5%. So in a sense, that business model of banks, to do mortgage now, given that no one likes to do industrial credit, is broken right now. So to a certain extent, I would have argued against even banking. It's just that from a purely macro point of view, on a day like this, you have to look for some place where you can hide at least for a moment when there's so much global uncertainty going on, which is why banks and possibly a big sort of a bit of a tactical heights there. But otherwise, the business model out there sort of seem broken. Some of the banks will have to reinvent themselves, or the cost of borrowing has to go down dramatically. And which is why kind of I am thinking as of right now that Indian rate cuts actually will be substantially more than what markets are pricing in. I made this point to you many times, Aisha, that I think in 2026 we will have 5 handle on 10-year bond, not 6 right now.
All right.
That's the headline. Great having you then on the show, Maneesh. Thanks for your thoughts as always.
Thank you.
If you like this video, then like, share and subscribe to ET Now.